Hey, welcome back to another video. And today we got one that was promised in the last video, and that is how to avoid any new taxes that may be coming down the pipeline. We've seen the polls, we've seen the tax plans, so I guess it's kind of time to get ready for those new taxes. So anyways, before we get into that, make sure you hit that thumbs up button down below because it does help my channel grow. I didn't even mean to rhyme that, but maybe I will from now on. Anyways, let me get into this. First thing that we want to talk about is just three little precursors because they are relevant to what I have to say today. Number one over here is tax revenues versus tax rates. So if we look throughout history, tax revenues versus tax rates, you don't always see a linear progression of tax revenues versus tax rates. So I like this quote. It's from Thomas Sowell, and it goes something like this. It goes, "There are no solutions, there are only trade-offs." So in other words, if you raise one type of tax, then people will try to do something else. If you raise income tax, people will stop paying themselves in income. If you raise some other type of tax, maybe like dividends types of tax, people will stop paying dividends. If you raise capital gains taxes, people will stop selling their assets just long enough so that they can hide their wealth and get around that tax. So basically what I'm trying to say is that the tax system is not only for what it is said to be about by certain individuals. It's not just about raising revenue. It's not just about redistribution of wealth. It's also about guiding behavior. It's also about developing infrastructure. It's also about helping business conditions. It's about a lot more than just raising revenue, because if you were to change one type of tax, like we said before, there are ways to get around that one type of tax. A lot of people do not understand that because most people, the vast majority of people, are only taxed in one way. They're taxed on their wages, which they get from their employer, and that's how they think taxes work. You make money, you get taxed by the government automatically, but that's just not how things work in the business world. So we're going to talk about that today. And one interesting thing, I'm going to throw this up on the screen right now, is that tax revenues have not always gone up when tax rates went up. So just because tax rates went up during Obama's term, or if they're going to go up after Donald Trump's term, or because they went down during Donald Trump's term, if you look at it, what you see is a linear progression of tax revenues. So what does that tell you? Does that tell you that this is Obama's economy continuing? Does that tell you that this is Donald Trump's economy, continuing to improve? The reality of the situation is, while America's worried about red and blue, and America's worried about white and black and cops and all these things, the World Economic Forum, the people who are organizing the world economy, the U.S. economy, the Federal Reserve, they're printing money. As more money goes into the system, tax revenues will naturally go up because there's more money in the system. The rich and the poor, the gap will get bigger, and that is what's really going on. Number two is fiduciary responsibility, and basically what fiduciary responsibility is let's say you were my client. If you were my client and I was servicing you in some way, that means that I have to act in your best interest. For example, a fiduciary to a person buying a house would be their real estate agent or their real estate broker. That real estate broker, even if they have some type of relationship with the other side of the transaction, the real estate broker still has a fiduciary responsibility to their client, whoever that may be. And why do I bring this up? The reason why I bring this up is because executives, by law, by U.S. law, have a fiduciary responsibility to their shareholders, or in other words, to the people who own the company or the American people, which people don't like to say that that's the case. 30% of wealth is held in retirement accounts. I think it's 32% of wealth is held in retirement accounts, and then nearly another 30% is held in people's homes. But anyways, we'll breeze past that. But it is the American people that owns these businesses. They have a fiduciary responsibility. So what does that mean? That means that if they're able to reduce the taxes of those individuals, they are required by law to do it. So just because you change certain taxes, you move this one up, and then you don't change that loophole, they're still going to find the loophole because they have a legal obligation to. And this last concept, labor cost per output, and you'll see why these three are relevant and why I have to go through them before we start the video, because they're concepts that a lot of people have not heard of, and they will basically have this misconception that's easy to take on because we're emotional creatures. And these ideas are easy to take on from the media because we don't think about things in terms of what is correct or what is factually correct. We think about things in terms of what we believe is fair or what we believe is just. So if somebody presents us with a narrative that sounds like injustice is being done, we will naturally take that on and we'll fight against said injustice. So labor cost per output, let's check this out. All right, so I've got an example over here of labor cost per output. So imagine that you're hiring two different people. One of them is some kid and one of them is, some grown man who has a riding lawnmower. The other one is the kid who has a push lawnmower. So let's say that you're hiring the kid and you want to pay the kid $3 per hour because they have a push lawnmower and it's going to take them 24 hours. And if you guys understand math, you're going to see where I'm going here. And you have the other person who has a riding lawnmower and you are willing to pay them $24 per hour and it's going to take them 3 hours because you have a really big lawn. Does it make more sense, or is it more just to pay this person $3 per hour for working for 24 hours and getting the same job done and also putting your yard out of commission for 3 days? Or does it make sense to pay this person $24 per hour for 3 hours? The thing is, you're paying both of them $72. So when you think about it in terms of labor cost per output, you're really paying for the same thing, right? So one person is making $3 per hour, the other person is making $24 per hour. What is the reason that one person is making more? It's because they're more effective at what they do because of the infrastructure that they have. The reason why I say that is because when you offshore jobs, you don't necessarily get more out of your labor cost per output if the infrastructure in the place that you're going is not as established. So when we talk about offshoring jobs, it's not necessarily advantageous to always send your labor overseas because they may not have the same skills, they may not have the same infrastructure, the same roads, the same ability to fly in and out, the same ability to have helipads, whatever. So just because you can hire somebody for less doesn't mean that it's unjustified, for one, and it doesn't mean that you're necessarily getting more for less. So now that we've got that precursor out of the way, let's go ahead and get into these state taxes. So state taxes, this one is pretty obvious. If you are getting taxed, such as in California, you're getting taxed up to 13%. If you're getting taxed that much in California, the obvious answer is to do what Elon Musk did and move your business out of California. So that one's pretty simple. If you raise your state taxes, things that people don't understand is that the tax systems, you're competing for businesses. If you create situations that are so hostile to business will not want to exist in your state. If you do that federally as a country, businesses will not want to exist in your country. And we cannot ignore the unignorable fact that if you make business conditions so hostile in your country, capital and rich people, they do not need to stay in your country. Capital goes to where it can make the most friends, if you will. Money wants to multiply. People with money want to multiply their money, and they're not stuck here. The only people that are stuck here are people without money that have to work for wages, that don't have enough money to pick up, fly elsewhere, move their business elsewhere, have multiple homes in different places. The people who actually create jobs, they can leave. If business conditions get too bad here, they can leave. Income taxes. 12.4% Social Security tax on anything above 400K. So the way to avoid this is by not paying yourself an income. So according to the law, you have to pay yourself an income as, let's say, an executive or an owner. You have to pay yourself a salary that is reasonable for what you do within the company. So that is very flexible, and you need to talk to a CPA. Talk to a CPA about all of this stuff that I'm mentioning in this video, because I am a knuckle-dragging soldier in the U.S. Army, and I am a lab tech at LabCorp. So I work in microbiology and the Army. So make sure that you verify these things with a CPA, but I will try to provide as many screenshots and sources on all my videos so that you guys can verify that this stuff is legit. Anyways, all you have to do is reduce your taxable income. So there's many ways to do that. And one of the ways to do that is by contributing to, say, an IRA, contributing to like a SEP IRA, or investing in real estate. So if you invest in real estate, you can write off up to $750,000. The interest on that debt, you can write it off, which if you had a 3% interest rate, that's $22,500 that you can write off of your income. The Tax Cut and Jobs Act actually decreased this. So It used to be $1 million filing married, but now it is $750,000 and $375 for yourself filing single. States that don't have income tax as of 2020 are Wyoming, Alaska, Florida, Nevada, South Dakota, Texas, and Washington. It's very popular to hate on people who make above $400,000, and I can see why, because it seems as if they are extracting value from the community and they're being greedy. But when you take on a different philosophy, you realize that the cost of labor is the cost of keeping labor in place. In other words, why is, say, LeBron James paid so much? Why is he paid millions and millions of dollars? Or why is, let's say, the CEO of Microsoft paid so much? Why is Jeff Bezos paid so little? Why is Elon Musk paid so little? Why is Warren Buffett's salary so small? The reason is because of incentives. So Satya Nadella, the CEO of Microsoft, is not a very big stakeholder in Microsoft. So when Microsoft stock goes up, when the value of Microsoft goes up, he does not share in very much of that value. The same thing goes for LeBron James. LeBron James owns none of the Lakers, but LeBron James basically is the Lakers. Besides, he has very good teammates. Obviously, I didn't watch that much basketball this year, but LeBron James has very good teammates, but he owns none of the Lakers. Jeff Bezos. Jeff Bezos owns a goodly portion of Amazon. And then Elon Musk, flash his salary on the screen. This is how much of the company he owns. Same thing with Warren Buffett. Flash his salary on the screen right now. This is how much of the company he owns. So those people don't want to necessarily pay themselves so that they can have these high income taxes. The reason why those CEOs are paid so much is because they generate so much value for their companies. The reason why someone like LeBron James is paid so much is because he generated $115 million in profits. So of course he's worth his salary. The reason why somebody like, say, a busboy or a checker is not worth as much is because if that person wants to leave, someone else can come push carts, and it's not that hard to replace them. So if you want to generate economic value in this world, you have to make yourself not replaceable, do something that's valuable. And when you realize that, you realize that all this red, blue, white, black stuff doesn't matter. What matters is how valuable you can make yourself. So I forgot to mention this during the video, but another reason why I wanted to say that the Social Security tax on people making above 400K is not necessarily the fairest is because, for one, those people are creating the jobs. So if they don't have any money, they are going to be able to create fewer jobs. The jobs will have to come from the government. And for two, the people who are making above 400K don't actually need to draw from Social Security. So the tax is not necessarily for them, but it is being levied against them. So let's move on to some corporate taxes. So corporate taxes, the plan is to bring that from 21% up to 28%. So the better way to look at that is it's increasing by 33%, because when you actually go and value something like a stock, aka the thing that's in everybody's 401k right now, you have to look at it on those percentage bases, because that's what percentages are going to actually matter. What's happening now versus what is proposed. So that could be a huge drop in earnings. And the only way to get around that is to basically not show as many earnings. So things like research and development, things like plowing money back into the business. An unintended consequence of raising the taxes would be incentivizing issuing stock options. Basically, when you raise the taxes on profits, you disincentivize profit. So one way to get around that is to have more expenses. One expense that you can have is issuing stock options to your executives or to your owners. This counts as an expense and it can be written off by the company. Another unintended consequence of raising taxes here domestically is that U.S. companies may choose to move their businesses back abroad. In addition, if you were to set up your business in, say, the Cayman Islands, you would have lower bank regulations that allow you to hide your money. And if that is incentivized, what you're going to essentially see is you're going to see more of those things. And in addition, you'll pay the GILTI tax rate, which is the global intangible low tax income. And basically what the GILTI tax is, it's taxed at the corporate tax rate, and then you can deduct 50% of that according to current law. What Joe Biden is proposing is doubling the GILTI tax, or in other words, making taxes equal to what they are outside of the United States, and then raising taxes inside of the United States. This also doesn't address the fact that raising taxes inherently raises the labor cost per output of every country that's affected or connected to the United States. So it raises the cost of the economy as a whole, of the global economy as a whole. So essentially the idea is that taxes outside of the United States and taxes inside of the United States will be the same amount, so you'll be just as likely to do business outside as inside of the United States. However, the problem still exists that capital will want to flow to the lowest tax rates. So if we cannot find it in U.S. businesses inside the United States and you cannot find it in businesses outside of the United States, you might need to find it in different countries. And like we said before, if you have enough money to start a business and run a business, you also have enough money to leave the country. I need you guys to hold on to your seats for the end of this video because this is going to get a little complicated, but there are 6 ways to avoid the GILTI tax. And let me just, this is the last thing that he had. I mean, tax credit, increasing the tax credit for children. We're not going to even address that one. I just wanted to make sure that I mentioned it, and then we're going to go into the ways to avoid the GILTI tax, and that'll be the end of the video. Number 0, because I forgot to put another part of my own video in the video. This video sucks, y'all. Anyways, subpart F, income. This is another way to avoid GILTI tax. So this includes insurance income. That is a way to avoid the GILTI taxes. And these other ones look pretty illegal, so we're going to move on to number 1. Number 1 is qualified business asset investment. So let's say that I'm a manufacturer. If I'm a manufacturer, I can go build a plant in a different country and essentially write that off because that is an expense. I can write that down against my other income that's in that country. So let's say that I make $1 billion over in Singapore and then I build $1 billion plant. Well, I made $0 that year. Even though the wealth that I've created is not zero, the wealth that I've created is that $1 billion plant, which I don't think plants actually cost $1 billion, but that was just an example. Number 2 is combining foreign controlled companies, or CFCs. So in other words, it's kind of like what I talked about in my other tax video. It's if you put 2 businesses together, if one of them loses money, one of them earns money, you can offset those losses. Okay, number 3 is avoid having CFC status or U.S. shareholder status. So basically the way that you would do that, if to have CFC status, you have to own 50% of the business. So you would essentially give, you would make it so that you own less than 50% of the business, in which case you would not be the controller of the business. So in other words, it's not your foreign owned company at that point. Number 4 is place U.S. shares into a C corporation or a U.S. holding corporation. After you do that, you can basically take a 50% deduction on GILTI. Number 5 is place the shares of the corporation into a private placement life insurance policy. So this is how it works. You put shares of the business into the life insurance policy, and as the business grows in value, you borrow against the value of the business, because taking out debt is not actually making income. So you're borrowing against the death benefit of the policy until you die, essentially. And then when you do die, the death benefit pays out, it pays off that debt, and then you essentially got out without paying that GILTI tax because you put it into a life insurance policy. In addition, the death benefit of life insurance policies are tax-free to whoever your beneficiary is, and it'll just pay off that debt. From the sources that I saw, this doesn't make sense unless you have at least $10 million of assets. So anyways, hopefully you guys like this video. I like being a little contrarian, throwing a little bit of dirt on the plans that politicians have to take away your money. So anyways, hopefully you guys liked this video. If you did, make sure you give it a thumbs up, and I'll see you guys in the next video. Join the Facebook.